You run a small bakery. Your cakes sell out almost every day. Customers love the brand. Yet every month, when you check your bank account, it's still empty. So you ask the most dangerous question in business. If sales are strong, where did the money go? That question is exactly why cost accounting and budgetary control exist. This is the Learning Studio, and today we're breaking down how businesses track costs, control spending, and stop profits from quietly leaking away. Financial accounting tells you what happened. Cost accounting digs deeper. It tells you why it happened and what to fix. Take a simple example. If one cupcake sells for $12 but costs $10 to make, that $10 didn't vanish. It went into ingredients, labor, electricity, rent, packaging. Cost accounting forces you to see each layer clearly and decide which ones are helping the business and which ones are draining it. But before costs can be controlled, they have to be understood. Some costs don't move. Rent stays the same whether you sell one cake or 100. Others rise with activity: ingredients, fuel, hourly labor. Some sit in between, partly fixed and partly flexible. This distinction matters because pricing, expansion, and survival decisions depend on it. A business that treats fixed costs like variable ones will always misjudge risk. Once costs are understood, measurement begins. Businesses don't just record costs, they compare them. What should a product cost versus what it actually costs? That gap tells a story. If costs come in higher than expected, something went wrong. Inefficiency, waste, poor planning, or rising prices. If they come in lower, something worked. Either way, the numbers point directly to action. That's where variance analysis becomes powerful. It doesn't blame numbers, it questions causes. Was more material used than planned? Did labor take longer than expected? Did overheads quietly rise without notice? Good managers don't fear these questions, they rely on them. Then comes planning, because reacting late is expensive. Budgets are simply forward-looking decisions written in numbers. Expected sales, planned production, cash coming in, cash going out. Budgetary control means comparing reality to that plan, early enough to adjust. If cash comes in slower than expected, spending is tightened before damage is done. That's not restriction. That's discipline. This logic is everywhere. Airlines price seats based on cost behavior. Hospitals track cost per patient to stay operational. Even schools plan staffing and facilities through budgets. Cost accounting turns intuition into evidence. Budgetary control turns hope into preparation. And historically, many of these ideas were shaped during the industrial age by thinkers like Frederick Winslow Taylor, whose work on efficiency and cost control influenced how modern businesses measure and manage operations. In the next video, we'll move into auditing principles and internal controls, how organizations protect themselves from errors, manipulation, and fraud. Subscribe and continue with the playlist. This is the Learning Studio. I'll see you in the next lesson.